everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, Mr. Yaki Boom Boom. Doing good, bro. How you doing?
Man, I'm always making it happen. I think I got one more month in my great room here before the construction is done, get back into the office. Then we got a second office coming for the team. So we have good things coming. We're going to get a better backdrop going for the YouTube folks here. So we don't have the bright lights and the lake behind us anymore. But that's my story, and I'm sticking to it. Guys, this is where we would normally plug something to pay the bills. Now for our listeners, we only showcase products and services that we approve are used in our own business. This time we're going to tell you about something of ours, specifically our Wheelbarrow Profits community. G-Dad, what say you?
Stenziano, we've been growing at Stenziano. We've got a lot of people on the educational platform. We have a great LMS platform. We host on Kajabi. We call it the Wheelbarrow Profits Academy. It's the three legs, Jake. What are they? Buy right, manage right, and finance right. That's what we're teaching. We're growing an awesome community. We have a nice private Facebook group. So if you guys want to learn more, go on our website, jakeandgino.com/hit the apply button. You can fill out your form. We'll have one of our team members get back to you. It's all about starting right. And I hear everybody say multifamily is hot. Well, you're not going to buy an asset in the next month or 2 months if you're just starting out. You're going to need at least a 12 to 18-month window like Jake and I had to get our first deal. And I worked years before that to learn the space. So, guys, everyone goes to college for 4 years. Take the next 12 months to educate yourself, follow people who are doing it, learn how to do it, save your money. And then when the opportunity comes, as I always say, the richest man in Babylon, the opportunity's there. You're not going to be lucky. You're going to be able to seize the opportunity because you're going to know the opportunity's there. So don't hesitate. If you want to become financially free like we did, it's not going to happen overnight. It's going to take the next 3 to 5 years of hard work. As my friend Jake likes to say, I don't like to call it grinding, but it's going to be hard work, but you're going to love it because you know what? At the end of that rainbow, I guarantee, I will tell you, there's a little pot of gold there for you. And I call it Florida. I call it financial freedom. I call it being on this podcast. So guys, jakeandgino.com/apply.
All I got to say about that is your passion fuels my inner fire, my friend. That was powerful. I love you. Great job. Today's guest is Swapnil Agarwal. Swapnil is founder and managing principal of Nitya Capital and the CEO of its sister company, Karya Management. He has more than 13 years of financial and investment experience, including 8 years of experience in global real estate. He's taken us outside East Tennessee, Gino. So without further ado, Swapnil, welcome to the show.
Thank you very much. It's my pleasure, Jake and Gino, to meet you guys and being on the show.
Hey, it's our pleasure to have you here. It sounds like you have a lot going on. Why don't you just give us a little glimpse into how this started and your beginning?
Sure. So I grew up in a small town in India. I came to the United States in 1996 as a young 15-year-old teenager. I grew up in a lot of these Class B and C apartment complexes that today we own. And I saw the whole motivation behind, getting into business in Class B and C space was being a resident where I lived in my early childhood for 7-8 years. I saw a lot of lack of amenities and services that didn't exist for the residents in this space. So with that in mind and having a financial experience and background, I decided to start Nitya Capital and Karya Property Management in 2013 with the goal of improving tenants' lives, improving creating returns for investors, but at the same time creating a vertically integrated platform where not only we are, sourcing deals, executing transactions, but also at the same time managing it in-house, doing it better than anybody else can. And separately, we also have a construction company that does the renovation for all of our own properties. So that's been the history. So we started in 2013, and we've been very fortunate that we've grown at a very rapid pace. Today, we own and manage about 15,000 units across Texas. Worth at about $1.5 billion of AUM under management.
So what did you do before multifamily?
I was in a global real estate private equity firm. And as part of that, I was based in Hong Kong, where I was investing and sourcing transactions across Asia Pacific for 7 years prior to that.
So what markets do you like? Do you like the U.S. market in comparison to the rest of the world? Where do you like to target?
I think U.S. is probably one of the best markets in the world because you are able to generate, especially in this multifamily, Class B value add space, you're able to generate a decent, mid-teen returns with still having investing in a developed country. So if you go across Europe, you have negative interest rate environment. You're buying stuff at 2.5, 3 cap rates, whereas in US you're still able to get decent deals done at 5.5. If you're lucky at 6 caps, and debt is still pretty cheap. So I think US is a very, very interesting market. It's a developed country, and I think that especially in the Class B and C multifamily space, it's a great environment to be in.
Let's go back to your first deal. What was that first deal look like?
It's a very interesting story. My first deal was a 160-unit apartment complex in a pretty rough part of town. This was in March 2014. The total deal was $4 million. I did not have the net worth to do the deal myself, so I went to my close friends and family. At that time, raising $1.3 million was a big challenge. Even getting a debt finance at that time without having a net worth or the experience was a challenge. But we took the risk, took the plunge, gave personal guarantees and recourse. Was able to secure a $2.7 million financing. Was able to raise, luckily, the remaining equity to get the deal done. But once we acquired the deal, the first 3 months, I thought it was the worst decision of my life. I was sitting in a class, here I was coming from, working in a high-rise in Hong Kong, and here I am sitting in a Class B apartment complex, leasing off, paying a packet, trying to collect the rents and being threatened for my life. So,
hold on. So we have some similar experiences here, and what Gino and I have found in these types of apartments is there's a certain fragrance into the down units, and it's rotten fruit and cigarettes. So I'm sure you had a lot of rotten fruit and cigarette smells coming to you in that deal. Is that correct, my friend?
Along with that, there's plenty of other smells which I cannot even. When we took over the property, I think I had 160 units. I think 80 units were missing basic appliances.
Oh.
And even air conditioners on the 25 units were missing. And, at that time, we thought we did our due diligence, but between the due diligence and closing, there's a 30, 40 day period. And I think during that time, the owner had gotten rid of and taken along with him, bags with him. And I just couldn't believe that somebody would do stuff like that. So we walked in, there's units with holes in the roof. And we're like, what's happening here? Is the AC is missing. And you realize in the actual lease documents, he had said that appliances would not be provided, which is, very rare that apartments usually always come with appliances. So here we have a residence living with basic amenities where you include your refrigerator or your oven. And then, you take over a property like that and you're scratching your head. It's like, what did I just do?
Hey, quick tip to the guys out there. Rent ready. People get, when we're buying, people, push back on this and then they finally kind of get hip with it. We always ask for rent ready units. If the unit is going to, and then look, it doesn't have to be, a total upgrade or something, but when we're taking over, we want rent ready. And that means the appliances are in place, countertops, everything is there and it's ready to go if you had to lease it to somebody. So that's one thing that we ran into on our third deal with the 136 units. They were using all of these, the maintenance guys were using these as maintenance shops, all these units. And they're just filling them with junk, and the owners had no idea. So, guys, this stuff is real, and man, that's a tough pill to swallow. What was the price per unit on that one?
This is 2013. I paid $25,000 a door at that time, and I had plenty of guys telling me you're overpaying for that. I said, look, I just can't believe how you can overpay it by paying $25,000 a door. So I went ahead and did it.
Good for you.
And as you know, that last 4 or 5 years, just the market's changing.
So let me ask you, what was the rent or if you remember the unit mix and the rents that you were generating on that place? Do you remember that?
Yes, I think on the rent roll, the effective rent shown was about 71 cents a square foot per month.
Mm-hmm.
But I think once you took over, you found there's plenty of concessions that were being given, and so I think the effective rent was probably in the mid to high 50s per square foot.
So do you think you're getting $500 per apartment on average?
I would say at 160 units on paper, yes, it was being shown that it was collecting about $75,000 a month. So it's a bit under $500. But I think once we took over, occupancy dropped quite a bit because a lot of people were just living there to show a higher occupancy. So the collections dropped to about 60 to 63,000, and then the occupancy dropped to 65%. So it's quite a difficult thing.
But at $25,000 a door, your downside risk was limited because if you get the rents up to, even if they're $500 a month, let's say that's $6,000 a year, that's 4 times in 4 years, you'll have that paid back. Guys nowadays are paying $50,000 per door for that kind of asset. So you can see the downside risk is really a lot more now. We got to keep talking about this deal because there's a lot of stuff here. In the Rochester market, it's very similar. In Rochester, they'll say to you, hey, listen, appliances don't come. The refrigerator is not provided. So that's one really big thing. What other mistakes did you make on this property? As far as analyzing the property, it seems like there was some holes in the financial due diligence. What else did you, flounder upon?
I think definitely there were holes in the financial due diligence. I would say the physical due diligence could have been a lot better as well. I just didn't realize how bad the conditions were of the roofs and then there were some foundation issues. I just wanted to get a deal done, and so I think there could be a lot of things that could have been tightened up. But again, when you're trying to do your first deal, you were just very motivated. You were trying to ignore a lot of these, even though I recognize the fact that there will be issues after we take over. But I just thought I wanted to get something under my belt so that at least it's a start, so which we can move forward on.
So what was the turning point on this property? When did you start turning the property?
Yeah, I think it just needed care. It just needed attention. So I stayed at the property myself, for the first 6 months. I think the crime had to be, restricted. So you couldn't just let rent to anybody. You had to do your proper background screening. So as tenants realize that it's not a hub of crime anymore, that people just can't get access for drug dealings and other sort of stuff that were being done there. A lot of the riffraffs and the unwanted tenant base started moving out, and the better tenant base. So the submarket was actually good. The property was named Nordling Chateau in a very, very Hispanic-dominated submarket. First thing we did is we changed the name of the property from Nordling Chateau to Villa Nueva so that it could fit the submarket demographics. So a lot of local, the submarket, the Hispanic population started identifying themselves with this property. We did a decent marketing, so very submarket focused. Went in the flea markets, went to Fiesta, a lot of flyer distribution because the tenant base and their location are not going to go on Facebook or social media. So we targeted marketing, paying attention, proper background screening, and within 6 months our occupancy was back up in the high 80s. Collections were up over $85,000 a month, and basically that was the big part to play in the turning around of this property.
Guys, I have one tip for everybody on the call. Whenever you hear a property called Chateau, run. Don't walk, run from the property because it is not a chateau. It's not a villa. It is the opposite of a chateau. It's a hole. Am I correct or am I not correct on that one? Huh?
A lot of chateaus out there for sure. You don't run. You got to dive deeper and say that may be the smell of opportunity if you see chateau.
Yeah, you are correct unless you're able to buy it for $25,000.
Yes. I mean, I think Jake would call it more like, I don't want to curse, but he would call it a shitto, not a chateau. That's the problem. But $85K per month is great. What did you end up doing, Swapnil, with this property? Have you held the property? Did you end up refinancing it, selling it out?
This is very close to my heart because it's our first property. So we have refinanced it a couple of times and we still own the property.
That's great. That's what you want to do. So you return capital. You have a proven model. I mean, the emotion, thank God the emotion kicked in because this thing is probably a cash cow right now. Do you know what the value is? Do you think the value is probably $75,000 a unit right now in this property?
Yes, we just refinanced it and it got appraised for about $75,000.
Woo, there's some value right there, huh?
Yep. Yeah, that's what I'm saying. So from cigarettes and dried fruit to 75. That's
rotten fruit. We like dried fruit. We don't like rotten fruit.
Rotten fruit. So from that smell to 75,000 a door. So let me ask you, what was your next deal after that? How long did it take you to buy your next deal?
The next deal, so, we've grown from, in 4 years, from March 2014 to August or September 2018, 15,000 units. So we've grown very rapidly. So my next deal came in June of 2014. That was a 176 unit apartment complex about 4 miles from this Villa Nueva. And then the next property was a month later in August. That was a 163 unit property. Then the next biggest one was 2 months later. That was a 460 unit property. So we were fortunate because I realized the window of opportunity that existed back then. And the first 3 months at Villa Nueva or Nordling Chateau gave me a lot of confidence. I mean, first I was very scared that, look, this is a very difficult business. But once we were able to turn that property around, that gave us a lot of confidence to keep doing it over and over. And I think the best decision I made in my life was to reinvest the capital or the investment that I was making to hire more employees so that we can grow so rapidly. Because I could have easily taken a route where my goal was to own, let's say, 5 to 10 assets, and that's it, I'm happy. But I took an approach where I would continue to raise outside capital to grow at a faster level.
Wow. So I have a couple questions. Number one, how did you find these assets? Were they off market, broker relationships?
Yeah. So, obviously my first deal, you would laugh, was coming out of LoopNet because I didn't know any better. And then once I was able to execute one deal, a lot of brokers in town realized that, look, this buyer can actually close. So then it became a bit easier. Then, a lot of the same brokers started coming and showing me different deals. And a lot of them, yes, on an off-market basis because, the Houston market in 2013 wasn't as developed where every deal was getting listed. Plus, these deals are on the smaller end of the spectrum. So not a lot of these deals do get listed. So yes, most of I would say first 15 deals or so were pretty much on the off-market basis.
And give the listeners a couple of tips on raising capital, because it seems like you raised millions and millions of dollars in capital. What would you tell the listeners about raising capital?
Yeah, I wish there was a simple formula or a scientific theory behind how I can raise capital, but I think it's a lot of luck, and you just have to position yourself in a right manner. And you got to, a lot of investors, when I used to meet them, I used to have a nice presentation or an OM that I used to present to them. And I used to tell them straight that, look, any deal can look great on paper. Any deal looks profitable on paper. But you got to be able to look me in the eye and feel that you can trust me with your capital, and only then you can invest. So even when I was desperate, I was looking for capital, I still had my principles where I didn't show my desperation to the investors. I was being very honest. I was working with high integrity. I said, look, I used to ask them, how much is your total savings? I used to say my total saving is 200,000, and they wanted to invest 100,000. I used to refuse taking their investment. I said, no, you should not invest 100,000 of the 200,000 you have saved. Don't invest more than 25, say $50,000, because I want you to be able to sleep at night. So I think a lot of that went a long way with them. And obviously, when you're able to show performance, when you're able to give dividends and distribution every quarter, that actually gives them a lot of confidence. And then it becomes it's on a referral basis. I started with 4 investors. Today we have 378 investors, and we have not paid a single agent or a broker dealer to raise any capital. We have institutional investors. We have family offices out of Israel. And to be very honest, it just kept happening. It's not that we planned it, that we're going to go to this route, then we're going to have institutional investors. But when you perform, when your performance is great, your assets are performing, you have a great team, investors are just attracted to your model automatically.
Mr. Stenziano, I read a great quote that fits this. Man does not attract what he wants. He attracts what he is. So you can want all the capital in the world, but if you're a dirtbag and you're not going to pay people back and you're not going to be with integrity, you can get that money, but it's going to vanish right away. So listen to that quote, everybody. I wanted to be financially free, but I was in the kitchen sitting like this, and Jake knew it. I'm not attracting financial freedom, right? I'm attracting people like that. So be careful, not what you want, it's what you are, okay? Be, do, and have. That's what I've just been reading, and it's really, last couple of weeks, it's been really resonating with me and talking to high-level guys like Swapnil now. He makes the point. He's not out there trying to rape people and take half of their life savings. He's saying, listen, I don't think it's a good idea. I mean, how many guys on the call right now can do that? I don't know. There's a lot of us out there that really need that money. But if you take a step back and you look at the long-term perspective and a long-term picture, I think it'll benefit you. I know. I hope that makes sense to you guys. It just hit me like a ton of bricks right now. And I think that's how we have to all work with it.
G-Dad bringing the emotion today. I love it.
No, it's true, Mr. Stenziano. You know, we always think about, what do I want? What do I want? What do I want? No, it's not what you want, because we all want, everyone on the call wants stuff, but you have to actually be something before you want something. So I thought that was really powerful.
You got to be able to provide value, I think is the key.
Yeah.
So I would add another thing to that. And, I think that the key is always being honest with your investors. You obviously lay out your budgets, your projections, the monthly projections. And, in this business, it's very rare that you're going to hit those projections or you're going to beat them. And if you're not, you just be honest to your investor. You say, look, this was our projection. We didn't hit it because X, Y, and Z. But look, we are working very hard to achieve that. And they're happy to do that because if you continue to lie to them, you say, look, I tried my best, but, the market is bad. It doesn't go a long way with them. Plus, another thing is monthly financials. We created an investor portal that was completely 100% online. Every investor had a login. Every month we would upload the financials, which included a short summary of the month's performance, income statement, balance sheet, and every invoice, every expenditure that we had, the invoice was online. So anybody wanted to dig in further, they had access to that. And that showed a lot of confidence to investors because, look, everything is there. We are very transparent. This is how we are working. And we kept our fees very, very minimal also because let us prove to yourself that we can perform. And if you guys make money, then I will take my carried interest to promote at the back end. That's another way that it helps to raise capital when you're just starting out.
I love that. So what were the challenges growing so quickly?
It's always about the people. It's always about, look, especially in the multifamily space, you have, first 4 or 5 deals, I was the one, raising the capital. I was the one sourcing the deals. I was the one finding lenders and creating company presentations, doing the legal work. And then once the property is taken over, I was sitting at the properties. I was acting like a manager or regional supervisor, kind of making sure the property's performance. And I was also acting like an accountant, trying to prepare monthly financials. So the key is be ready to do everything once you're starting out, right? But then I quickly realized that I can't keep up with the pace. If I want to grow, if I want to have 50, 100, apartment complexes or more units, I got to keep hiring people. And I was fortunate enough that I identified a few of my, ex-colleagues and close friends. And I told them, why don't you come and join me? And, these people all were working hard, in their professional, jobs. And they had to take a leap of faith and trust me and leave their job and come here without much salary. But I was fortunate that they all believed in this vision and they all came over. And because of that, this is where we are. In terms of, growing too fast, finding the on-site employees, your maintenance staff, your plumbers, your HVAC repair guys, your leasing agents, that's a constant challenge. Today we have over 500 employees. And I think that's a constant challenge we all face in this industry all the time. And this was one of the challenges we faced, as we were growing as well.
Wow. So let me ask you, what is your best real estate tip for the listeners going forward in multifamily as far as buying and as far as continuing to grow?
I think the best tip I would say is don't be afraid to take risks. When you're passionate, for me, real estate it's an industry where you can feel, touch, evaluate things. You can see if that asset is in real estate, it's always about location, right? No matter if it's multifamily, retail, office, industrial, no matter which asset class, it comes down to your location. And if you feel that location is good, don't be afraid. Do your due diligence. Do your research behind the submarket, the growth, the occupancies, the trends, the comps. Where's your value add? What's the subject properties rent? What are the comps at? And if you believe that there's an opportunity that exists with an asset, don't be afraid to jump ship and take the risk. Don't just sit there and talk about it that I want to do it. That goes with any business. There's so many people, 99% of the population of the world wants to have their own business, but only 1% can end up doing it because they can never get rid of that paycheck security syndrome. You got to be able to leave that, and you got to be able to, say, look, I want to do it. If it doesn't work out, I'm going to go, what's the worst that can happen? I'm going to go back and get a job again. but don't be afraid to take risks is my tip.
That is the mindset, though. That's what I always challenge people to ask themselves. What is the worst thing that can happen? Because people talk themselves out of everything, but they don't ask that one question. What is the worst thing that can happen from doing this? And if you really dissect that and go down, man, that is such a great point. That's so much power there. I love your story, and we're going through exactly what you've already been through to this point. So we have a small construction company. We have our own property management. I want to dive into it. How many employees do you have on the construction side of things? Because I find this fascinating. And when you can control that side of it, you can reduce so much of your costs. Can you dive into that a little bit?
Sure. So that's absolutely a very, very important point, because the most of the assets that we were buying initially had a value add component to it.
Yep.
And what I mean by that is, when we buy these assets, we do interior renovation with some exterior renovation. Interior renovations include changing out the floor to vinyl plank flooring, putting in new countertops, which might be granite or some other, resurfacing them, new appliances, repainting the apartment, accent wall, new fixtures, hardwares, and then kitchen backsplash. So to subcontract it out, I realized, first of all, was very costly, and it was not very efficient, because if these third-party contractors, I think they all work the same way, everywhere in the country.
They don't show up. They overcharge. It's the whole gamut. So you have to control the process if you're going to really do what you need to do. I absolutely agree with that.
When in 2015, I found a crew of 4 people at that time. They came with one of the assets that we purchased. I convinced them to stay on. And in my mind, I said, look, I think we can do this ourselves. We have to do this ourselves to be successful. From 2015, from a crew of 4, now we have 190 people in that crew.
Nice.
All they do is they basically go around each of our assets. We don't do any third parties. We just work on our own assets. And they go, managers on every Wednesday send a list of units that they need renovated for the following week, depending on when the move-in dates are. And this crew will go around. They know exactly what they need to do. They need to do floor or all of the above, or few of the 5 things. We source the raw materials from other countries like China and India. And we are able to do this thing at a very, very cheap cost. And that means we can offer that product back to this tenant base with only a maybe $100 to $150 rent bump, because we're only spending $5,000 to $6,000 a door in this renovation cost. Whereas if I had third-party contractors, it would cost at least double, and then my ROI wouldn't make sense.
You are the man. I love everything I'm hearing today. This is great. What tip would you give to the audience when starting out for growing the actual property management side of things? Because it's very challenging without systems in the beginning and being able to pay folks accordingly. What's a good tip you can give to the folks?
Yeah, it's a very it's a very, very challenging, because if I had it any other way, property management does not make me any money. Because whatever money we charge on the property management side, it goes towards my payroll. Obviously, initially it's very difficult. So you got to be ready to do a lot of the heavy lifting yourself. It's okay to hire third-party management companies till you get to about a substantial base of 1,000 units. I think once you are at 1,000 units, you can invest some capital to hire. I would say you need an accountant to prepare monthly financials. You need a regional supervisor, and I would say you need one asset manager or a finance guy to look at the trends to it. So I think you need about 3 people for sure when you're at about 1,000 units, and then you can grow from there.
Nice. What would you have done differently starting out?
To be honest, my answer is I wouldn't do anything differently, because even though at that moment of time, I thought that I had more capital, then so I can hire more people to help me with this. But I think the reason we are successful is because I did everything myself. I know exactly what goes into managing a property at the ground level. And that's, I think, is the number one reason. A lot of people raise capital, they do deals, but they don't know how exactly managing what's exactly happening at the property. If you ask me, I have everything on my phone. I check every morning when I wake up, say, what's my occupancy? What's my delinquency? What's my collection? These basic KPIs you need to know. And as we've grown, we have 54 assets now. It's gotten more challenging. But when we had a 25, 30 assets, even up to that, I had memorized everything. I knew at any given point of time, what is my collection as of 15th of the month or 10th of the month. I knew how much more collectible delinquency we have. What's my current occupancy? How many renewals I have coming up in the next 30, 60, 90 days? That was all on my fingertips. So when you're starting out, you got to know everything, all the numbers inside out. You got to know, in terms of ground level realities, how much foot traffic did I get? What was the source of the new traffic? You got to know everything, because then you can market in those sources better. So I would say the biggest thing, my biggest recommendation for anybody that's looking to start out.
You're building a business. You're not in this for the quick fee game. And that's what I love about your story. And this is a real business that you have. So that's fantastic. What's a habit that you do on a daily or weekly basis that's allowed you to perform at a high level?
Make sure you go visit the properties at least once a week. It's challenging because now, we have assets in 5 different metro, cities of Texas. But I think it's very, very important to stay connected with the assets. Hold a weekly meeting with your regional supervisors, who are your eyes and ears to the ground, and also look at the numbers every day in terms of your collections, your occupancy, your renewals, your work orders. Number one reason you would be surprised for the turnover. Number one reason why anybody would move out is not because of high rent. Number one reason why anybody moves out is because of lack of customer service and maintenance turnaround. So you got to make sure that if somebody put a work order in, it's getting service, it's getting done within 24 to 48 hours. Make sure that gets done, because people don't mind paying extra $25, $50, $75 a month, because let's face it, if they move out, they're going to spend $1,000 to moving out, right? So it's easy for them to stay at the same property, but make sure their work orders, their customer service is top notch. So that's why stay connected with the ground, stay connected, visit your assets, have weekly meetings with your regional supervisors and your asset managers, and make sure you review the numbers on a daily basis.
I firmly believe that the key to success in the C&B space at this time is offering value and service. Not value from the standpoint of you got to be the lowest price, but you need to be offering value for value. And what that looks like is Chick-fil-A like customer service. When someone's asking for something, you need to be able to get it done. A lot of these guys get in for the fee game and then they're not able to support it, and they don't have the systems and they don't have the work ethic that he has to know what's going on the property in real time, because they consider themselves an asset manager. Whereas in your business, you're tracking these KPIs and you know what's going on and you're delivering that value and that service, and therefore you're able to retain folks. That's the difference between a successful C&B apartment right now and the rest. And that's my belief, at least. So any book recommendations? We always like to hear what folks are reading these days.
I'm a big Michael Lewis fan. I like a lot of his books. My recent favorite is, I'm a big baseball fan as well. My recent favorite is Astro Ball, which is basically by a writer that predicted that Houston Astros would win the World Series 3 years ago. And he wrote this book, and it's very fascinating that, when you drill down, you have this Moneyball concept in sports these days. And it's so funny and it's interesting that that same concept could be applied to what we do on a day-to-day basis in multifamily, because we have tons of data that we can draw for every day, from your properties. And what do you do with the data, right? It's so same thing on the baseball or other metrics, where they have so much data, and how do you make sense of it? So these are the things that fascinate me.
Turning those knobs and pulling those levers to see what's going to get a return, right? Absolutely, man. All right. What's the best way for listeners to get a hold of you?
I'm available. I'm on all social media outlets. So I'm on LinkedIn. My name, Swapnil Agarwal. I'm on Facebook, Swapnil Agarwal. Twitter, I think I'm on, but I don't use it a lot. My email is there, a.swapnil, SWAPNIL @gmail.com. I'm always approachable and will always respond back to any queries.
Man, this has been an awesome show. G-Dad, anything else today?
The only thing I'd have to say to everybody out there listening is there's no more excuses, because we keep having guys who are not U.S. born, who are immigrating to this country, and they get in and they jump in and there's no fear. So I constantly keep hearing people tell me that it's too expensive, they can't do it. Stop with the excuses. Start figuring out what you want to do. Start focusing on what you want to achieve in life, and we can all do it. It's not going to happen overnight. It's going to be a lot of hard work, and that's what people confuse. They think that if they just think they want something, focus on what you want. Look at people who are doing it. Contact Swapnil. talk to him, hear his story. It's a motivating story. You want to surround yourself with mentors like that. So at least when you have questions, they can at least answer to you because they're doing it every day. So it's another motivating, inspiring story from someone who came to this country and, just created an amazing freaking business.
I loved everything about it. I love everything he's doing. And I'm going to give a shout out to Dylan Marmer right now for turning me on to Art Williams, because what Gino was just saying is just do it. If you want it, put that out there, focus on it, go after it, and don't stop until you hit it. He did it very quick. He did it at a very accelerated rate, but it's out there if you want it. Don't sit there and say, oh, it's too hard. The broker this, the broker that. You want to start those excuses. You're never going anywhere. Figure it out. If you have to call 1,000 owners direct, oh, that sounds too hard. I don't want to do it. That's too much. Whatever it's going to take, if this is what you want, burn the ship, sell out, whatever it's going to take to get there and do it and make it happen. If not, stick with what you're doing and be a corporate slave. Those are your choices. So
I agree. Talk about burning.
I love you, man. I think that was so much value there. It was a great show. Anything else for the listeners today?
No, thank you so much. It was really a pleasure being on the show. And like you guys said, I'll summarize it as well. Believe in yourself. If you're really passionate, don't start a business to make a profit. That's all I would say. Don't start a business to make a profit. Profitability is the end result. Have a reason for why you want to do a business. My reason to start a business was I wanted to change people's lives. I wanted to improve the residents' life that live, because I was one of those residents growing up in America. I wanted to improve their lives. And yes, if you do a business right, if you have the right motivations, profit is automatically going to happen as an end result. Don't do a business just to want to make a profit. Do a business, have a reason why you want to do something, and then do it.
Awesome, man. Very good. Guys, appreciate it today. Great show. Thank you so much.
Thanks, guys. Take care.